Welcome to the latest installment of ABL Advisor's video series featuring thought leaders from the commercial finance industry. I'm Mike Toglia, the publisher of ABL Advisor, and today my guest is Dan Tortoriello. Dan is the Executive Vice President and Chief Operating Officer of SLR Business Credit. Thanks for being here today, Dan.
Thank you, Michael. Appreciate the opportunity.
It's my pleasure, really. Today we're going to be discussing how the current economic environment and the environment in general is impacting the asset-based lending industry, and get your thoughts on how things are moving in the marketplace. So if it's okay with you, I'll start right in on the first question I put together for us. Is that all right with you?
Sounds good.
Okay. So I'm just curious, Dan, how would you describe the current lending environment? And, maybe it might make sense to focus a little bit on bank versus non-bank lending environment. How is that working out? What's going on in the marketplace?
Well, I'd say the environment is efficient, maybe a little too efficient. But if you look at borrowers right now, whether they're looking for $100,000 factoring transactions, $5 million asset-based loans, or $50 million asset-based loans, whether they're in a turnaround stage, whether they're in a profitable stage, there's a lot of lenders looking for that business. There's a lot of people bidding on it. You're never alone when you enter into a transaction, and we don't take that for granted whenever we do look at a prospect. So, when you have so much money in a market, that's what comes to play. So what happens, right? What happens in that scenario? Interest rates usually get forced down. They're suppressed. So sometimes it's a race to the bottom. And then the credit side gets stretched. The 80% advances on AR become 95. 40% advances on inventory become 75. No financial covenants, no guarantees. Anyway, whatever. It's funny. It's like, as long as the lender doesn't say it's an over advance, they work it out. So you get a lot of players that come into a market. So what we try to do and how we address those issues is that we try to bring more than just money to the table. Jeff Goldrich and I, we've been working together over 35 years. Betty Hernandez, our Chief Credit Officer, 30 years. So we bring a lot of experience to the table. We specialize in certain industry types, whether it's staffing, whether it's food industry. We just purchased a digital media company out in LA. So we specialize in those things. We try to outline the pluses and minuses to a borrower, not just with our proposal, but maybe with the other proposals they're looking at, and try to make it more of a business decision, not just related to rate. Because if anybody just goes towards rate or whatever it may be and not think about the rest of it, could become a problem. So again, we try to make it more that we're more than just money for our clients. I think we have a little bit of an advantage being owned by BDC because we don't have the regulations, and we could be a little more flexible with balance sheet, income statement performance for borrowers. So, we play to our strength is what we try to do.
Yeah, and that's interesting to me because that goes into a little bit sort of what I'll call maybe the herd mentality. And that is that, everyone's basically, it becomes a race to the bottom in some ways, in a lot of ways. So right. Do you find that customers, the borrowers, are willing to listen, or some just myopically focused on the race to the bottom? Do you find people are willing to hear you out?
Yeah, you do. It's you see both. There's some that are really just fixated on price, and I get it. I'm not looking to spend their money. That's a business call, right? They've got to decide, is the cost worth whatever the advantage is? Maybe more flexibility, maybe more availability. Others are not as concerned with price. They understand that, and that maybe is more in an equity world, where a PE world, where they're more interested in driving the top line, and they know they need capital to do it, and they may pay a little extra to have it as long as it fits what they're looking for. So, we do both, and we've seen both. So that's why each deal is different, and you got to be able to sit down, understand what the concern is, and then let's talk about it and see if we're the right fit.
Yeah, and so you mentioned something that was what I was thinking about as well for my next question that I had prepared, and was we've seen, so there's a lot of players in the marketplace, but the players are also shifting quite a bit. You see quite a bit of private equity firms, alternative investment managers, private debt players, as you mentioned earlier. These folks are all aggressively chasing what I'll call the middle market without defining exactly what the middle market is. Right. Are they impacting it in a way that it becomes more difficult to keep up with the competition in the marketplace? I know you said it's getting stiffer, but is it becoming just that much more complicated because there's so many more players that are actually chasing this market at this point?
A good question. I hate to say this, but 30 years been doing this. I still can't believe 30 years, but 30 years. It seems like every year there's a lot of competition. I mean, the only thing that's different, the names change. I mean, before it might have been Finova, and it might have been Congress, and it might have been GE Capital, or even Business Alliance Capital, our prior company. And now it's SLR Business Credit and Sienna and stimulus money from the SBA. So I think there's always a challenge on it's always competitive. There's always the challenge. That's why we address it the way I mentioned earlier. You can't just go at it in one direction. That being said, I think it's a pretty good time to be a borrower right now. I mean, there's a lot of people chasing a lot of, not a lot of deals. So that's where we are, and you do your best with what you got.
It's the only thing that you can do, right? That's it. So there's a lot of destabilization going on in the financial markets today. A lot of erratic activity. There's certainly a lot of geopolitical risk that's going on out there, as we all know. We're in looks like to be a rising interest rate environment. There are still some supply chain issues going on that are impacting certain industries. These are all creating some sort of headwinds in the economy, but the economy seems to continue to move forward. How do you see some of these factors impacting the lending side of it and the borrowing environment? What's going on? What are you hearing from customers?
Well, first, I got to say our prayers are with these people in the Ukraine. It's a shame. I just hope they continue to talk, because usually if you talk, you're not fighting. So yes. Hopefully that continues in that direction. The other items you mentioned, though, are whenever there's disruption in a market, that's when we're at our best. Because, if you're thinking interest rates are going to raise 3 to 8 times, we hear the Fed may go up. All right. You mentioned supply chain. There's labor shortages. All of those things play a huge part in a borrower's decision making, and we've got to be part of that. And what we do is, we run towards the fire, I guess. You get burned sometimes, but the point being, you got to go in, you go after, understand what that issue is for each individual group, and then let's address that issue and figure it out. But you're right, each one of those components will affect an industry differently, but at the end of the day, you have to address them. You can't think they're just going to go away. So.
Yes, so it seems like, so when you think about it from a business development standpoint, or even from a credit underwriting standpoint, just trying to do business the way we were doing is not something that's an option, especially when you get into, like you just mentioned, a lot of the geopolitical risks with what's going on with Ukraine, the shame that's going on there, this 3 to 8 interest rate increases potentially. Do you find that borrowers are willing to talk and share, what's going on in their minds? Are they keeping their cards close to the vest these days?
I hate to answer it similarly, but it really is different with each borrower. We try to get to, what's the hurdle? Like, if you're talking to other people, and what was the problem, or what's your main concern? What is that? Let's talk about it, and let's figure out if we're the fit that gets you past that hurdle. So, again, if it's a staffing company, they have a different set of problems than a manufacturer who's trying to get product in, or so it's really got to be addressed, to each individual borrower as we see it. And But again, with the stimulus money getting drawn out of the, there's no hope, well, who knows, but additional stimulus money coming in, if interest rates start to go up and that draws a little more liquidity out of the market, our borrowers have to realize that, and they've got to understand how they're going to address it. And we got to walk through that scenario. So.
Well, and therein lies the relationship, a consultative approach to working with the borrower. That's what you're talking about, really, right?
Yeah, no doubt. Exactly.
So let's talk about the past 18 plus months or so. A lot of things have been going on, as you mentioned, but I'm just curious with the pandemic and everything, the PPP money, anything that was going on during this time. One question that comes to mind for me is, did you see any unforeseen opportunities present themselves for SLR as a result of the pandemic's impact on certain sectors? Did you see anything like that? Any new opportunities?
Well, it seemed like everybody you talked to knew how to import masks and hand sanitizers and gloves, and we turned them all down, I think, except one, actually. The one we did, to talk about an upside, it was an individual who already had a supply chain in place. He was already selling to the market. He was doing it at a much lower scale. So that hand sanitizer market increased tenfold for him. And we were able to leverage his receivables to allow him to continue to sell into that market. So that was a real win-win for us and for him, but that was few and far between. We are seeing, again, this quarter has been a lot better than last quarter. There's more activity. Last year we probably looked at half the amount of transactions we normally do. We closed about half than we normally do. But that being said, the second half gained some momentum. This first quarter's gained some momentum. We're cautiously optimistic for the upcoming year. So, that's where we are right now. And I think that's what we're leaning into this year and see what we can do.
Well, it's been a challenging year for a lot of the lenders out there, playing off of what's going on in the marketplace. So we're in the new year. Things are moving in the right direction, which is good news, and hopefully they stay that way. But and this might be a loaded question, but this is going to be what I'm going to ask anyway. So, what are you most concerned about? And you might have had 5 answers for this, but what are you most concerned about as we get into 2022? As we're into March at this point, what's on your mind?
I think the biggest concern is the liquidity question for each of the borrowers. I mean, the stimulus money masked a lot of problems for a lot of people, and it got them through, which is good. It helped, with the situation. But now when that starts to dwindle down, and especially on the healthcare side, there was a lot of stimulus money put into that, but now that's getting repaid back. The borrowers really need to focus on how that's going to affect them. It's coming right off the balance sheet. If interest rates go up, because most of our borrowers are, a half a point affects them dramatically. It isn't just another number on their balance sheet. We're usually the biggest supplier for them money. So that cost goes up, something else has to move. Whether it's a price increase or something like that, but whatever it may be, they got to make up that difference. So that's really probably our biggest concern, is as much as the stimulus money gave us a better loan to value in our portfolio, our outstandings were down. That was the blessing and curse thing. But at the end of the day, that's going to get paid back at some point. And so we've got to be able to address that and help the borrower, maneuver through that.
It's interesting because that creates the underwriting, the need for underwriting to be that much more close to the client too, I would imagine, because at this point now, when you're analyzing the statements, this one-time injection of liquidity, well, maybe we could all a one-time event, we don't know, but we'll say a one-time event, right. Certainly made things manageable. There, as you said, it's coming off now at this point. Now what? We're back to normal. You got to borrow money again. You got to borrow money at an interest rate that's going up. So there's a lot going on right now, isn't there? You're really balancing right now with credit and sales, right?
It really is. I mean, that's why the credit person and the business development person really have to work hand in hand. The business development person that does best here has that credit knowledge or can bring that to the table also, because does this work? Is a critical component of the front end of the transaction, and then handing it off to the credit side. Again, they got to work together. It's like anything else. Is like you're only as good as your weakest link. So credit, underwriting, ops, new business, legal, it's got to come together. And, all of those points have to work. That's just how we try to operate it. So.
Yeah, it takes the team. It takes the team more than ever. So, the way I'll wrap it up is, just curious about your priorities. I know volume is going to be a priority. So you can say that first.
Always is.
Yeah. So, but obviously you can speak about it, but what are your priorities for this year?
I think, there's really two main priorities. I mean, our clients and our prospects are always our priority. We want to be able to meet their expectations. I mean, they come to us for a reason, a referral or whatever. So we want to be able to meet their expectation of what we do and how we do it. The other priority is our people that work here. I mean, this is going to be a big change. We're coming back in from a pandemic where we want to be able to, like I mentioned, have that cohesive group again, because we feel we work better when we're here as a team. It works better for everybody. Those two scenarios are really, again, I think our priority. And if you could do that, if you could take care of your people, take care of your clients, the rest is going to take care of itself. So easier said than done sometimes, but that's what we're trying to do.
Okay. Well, Dan, that's going to do it for today. I want to thank you for your time and for sharing your insights. And I know that you're going to have a good year. I do wish your team the very best as you go into the year. And I'd like to check in with you in about a year, see where you stand, how things are going for you.
Michael, anytime. We appreciate it again. Thank you.